Hey traders, Raghee here. Welcome to Charts and Coffee. Great to see everybody. Yeah, I no sooner got the screen share going and everything just went blah. So we should be good to go. Technology is awesome when it works. All right, everything's good. All right, so welcome to Charts and Coffee. Happy CPI Friday, everybody. I see some questions about the CPI here in the Q&A right off the bat. So, I was gonna cover that. So let's just dive into the question, shall we? All right, hope everyone's doing well. Okay, so let's get to it. First of all, Michael, good morning. I bought the 92 and a halves and 95 Jan 21 calls on. All right, Oracle. Okay, let's jump into Oracle. It seems like it will gap up today after yesterday's earnings. I want to take. I want to wait. I want to take profits. Did I do it right? Oh, okay. So, Michael, as far as a fade goes in terms of wanting to get long, here's what I will say. And you have the. So if you get your gap up, awesome, right? If you get your gap up, I guess here's what I'll tell you. You're out of the money on those. So Michael, here's the thing, and it's not going to be the answer about Oracle you're probably looking for, but in general, whenever I'm going to play earnings, it's not going to be right in front of earnings. So I'm already going to talk about a trade I'm typically not going to take. Not that there's anything necessarily wrong with what you took, but it's just not something that I would consider in my a pitch for me. Having said all that, again, did you do it right? What was your plan? Right? What was the plan surrounding the trade? And did you have a target? And were you, and here's the most important part, were you ready for the risk? Because it is disproportionate around earnings. Were you ready for the risk that taking an options trade into earnings could present? So to me, I would typically expect 40 to almost 60% risk on premium paid in that situation. As far as if it gaps up, and if you want to pay yourself on a Friday, here's my advice always on taking profits. If you want to take an optional level, oftentimes when we're day trading in the mastery or day trading in the futures room, and I'm hitting an optional level that may not have been necessarily my first target, but I want to pay myself, especially because perhaps it's Friday or we had a disproportionate volatility move and I want to capitalize on it. What I'll say is scale out of half and put the rest at break even. And that's usually something that I think works in any situation. All right, next up, Line Watcher asks, the CPI numbers are out. Yes, they are. So for those of you that are still working on getting the economic calendar as part of your regular habit, this is why it's so important. If you're looking for a good why, here it is. We are going to have the markets today sort of primed already with a pretty strong opinion about what this CPI means. It's an inflation number, right? To not the stock market, right? The question is, the numbers suggest we still have elevated inflation. Why is the market rallying? So Line Watcher, there's a little piece in the middle, and that little piece, that tiny piece, is the Federal Reserve and the monetary policy path that they have us on. The market is rallying. Take a look here. And remember, the rally that might come just moments after a CPI, as opposed to maybe 15 to 20 minutes, we had an initial reaction that shot straight up. And then now we're just hovering. My expectation is 9:30 might echo some of that move, or at least that sentiment, if not that momentum. Here's what I'm looking at, Line Watcher, because let's ask ourselves the why. Why are we looking at the CPI to begin with? All right, why are we looking at it to begin with? Because inflation and growth data map to what we expect the Federal Reserve will do in terms of when will we see that first rate hike. We can measure that a lot more directly, and this is how. We look at the Fed Fund futures, and even easier, we look at the CME Group's countdown to FOMC graph. And one thing that we want to see remain, and one thing the market would be happy about is number one, 1/10 is not a huge jump. So inflation's not doing anything other than what the Federal Reserve is sort of laid out there. But for me, I look right here. Are the expectations for a rate hike coming in any closer than June? And with this column right here, they're not. And that's why I say it makes sense to look at what the CPI is affecting and then keep an eye on the best way to look at that expectation for rate hikes on a rate of change basis. And so that's why when I look at what's happening here, there's no reason for them to freak out. And there's no reason to adjust expectations any sooner than June, right? Anything that inches us closer to May becomes problematic. Anything that remains June or heck, even beyond is even better. Okay. All right. And remember, we're also in the good news is bad news, or, good data or data that suggests growth is on track, employment is healthy. That's going to sometimes become a bearish factor to the market. So be careful. It's not an easy. It should not be an indicator read. The best way I want to say this is it should not be an indicator read. It's a psychological reaction read, and the reaction is really best taken right to at the core of the issue is, which is, are we going to see rates sooner or later? So thanks for the question. William asks, my UUP calls for January are up. Cool. We're very bullish dollar, which is to say in equal breath, bearish the euro. Will this have a negative impact? It hasn't so far. Now, so William, kind of to Line Watcher's question, if the equity markets want to see what we collectively have discounted as the June rate hike to stay steady, so too does the dollar. If we're still on that trajectory of seeing rate hikes in June, why would the dollar sell off? This is still part of, right, what the market is anticipating. It's discounted. It's keeping the trend intact. So interestingly enough, if we were to move to May, dollar would probably rally in a more significant way. If we were to move out to July or further out in the year to see those first rate hikes, then we might see weakness. But there's no reason for the dollar to divert from its current trajectory because the data didn't change what I would say is the reason for the strong dollar, which is we're going to see rate hikes. We're not going to see them any later. So it's actually pretty quiet right now. I mean, notice the dollar really didn't do a whole heck of a lot. Quick sell-off took back a lot of it. This sell-off might be what you saw, right? The sell-off right after that. That dollar sell-off, we're going to see volatility. If you have a June 21 option, my friend, don't worry about looking at a 1 or 5 minute chart. Stay on the daily because that's really the time frame and the time horizon that's probably going to map best to your position. So it's so easy to let an intraday time frame sort of make us nervous about a longer time frame, longer time horizon position. Don't worry about it, right? I think the further that I have gone in my career, the fewer time frames I'm actually considering. There was a time that I looked across the, ready? 5, 15, 30, 60, 120, 240, 480 daily, weekly. My layout was a gazillion charts. So I was looking for lineup and multiple time frame confirmation, and I don't do any of that anymore. I realized that I either have a foot in the camp of I am a day trader, pick the short-term time frame, pick 2, 1 and a 5, 2 and a 5, maybe a 5 and a 15. That's your short-term world. And if I'm not there, I'm on a daily time frame. And that has helped me so much with clarity in terms of not, and here's the danger in multiple time frame confirmation, which I know is very popular, but I've completely left in the dust. If the 30 doesn't agree with me, but the 60 does, all of a sudden, the 60 is my jam, right? And if the daily is not agreeing with me, let's just see what's happening on the weekly, right? We will find what we want if we keep jumping around time frames. And rather than accepting that our trade idea may just not work, we're going to keep looking for the time frame that agrees with us. So that's where, for me, I eliminated that issue by saying, I'm either a day trader. This is the trade that I found on this time frame. Here's a confirmation, or I'm looking at the daily. So simplicity. All right, moving on. Do I see metals finally trying to find a bottom today? Well, when you say metals, Austin, each metal has a different reason for moving. Each metal has a different uh, structure and different catalysts. So we can't lump metals together. We have to look at them separately. So if you're looking at palladium, platinum, gold, silver, copper, heck, uranium, however you're looking at metals, steel, so the SLX ETF, we want to separate that out. So gold, I don't know. It looks like it's trying to bottom around this Darvis area between, I'd say 1760 and 1763. Gold looks like it wants to find an oversold support level there. Silver is actually looking like it wants to turn into an uptrend. And silver, if it can show a little bit more resilience north of the 200 propulsion and can hold this 55 propulsion, this could be an interesting chart to look at for the long side. Silver. Copper is something we've been talking about in the futures room, and that is when it bounces down to, or when it sells off down to the 200 propulsion, that's where we want to focus on where this dynamic support can be. So that's the white, these are the white dots and the white line. So copper, but interestingly enough, all three are buys, but have different structure, and their timing isn't necessarily going to gel. So are they finding a bottom? I mean, to your question, Austin, I think so, but please treat them as the individuals that they are. Copper is more about a economic optimism. If it's going to move higher, typically going to benefit from a strong stock market. Silver has got some manufacturing application like copper, but it also has some sensitivity to real yields like gold, and gold is all about real yields. So they're going to move for different reasons. But to, succinctly, yeah, I think they're trying to. And those are the levels that I'm looking at. All right, thanks for the question. NEE. All right, the number one holding in the utilities ETF, which is just absolutely in fuego right now. And think about what happens when we have fear in the market. Utilities and staples tend to benefit disproportionately, right? And I think we see NEE as a number one holding within the XLU ETF, the utilities ETF. I think we see them. I think we see them moving higher. NEE looks even better than XLU, so it's a relative outperformer that I think does not need XLU to move higher. It does not need the tide. This boat is absolutely doing its own thing. So pullback buys along the lines of specifically, say, the one we saw on November 26, also December 3. You can even probably say going back to November 4, just so you can see the kind of move candle zone that I would take advantage of. We need one of those again, but I like NEE to the long side. Good eye. I really like it a lot. Yeah. All right. Let's see. Next up is IWM, the Russell. Sure. So the Russell is definitely in a bit of a tug of war between anytime a market's in chop, I think you see sort of the bulls and the bears really duke it out. Who is going to own the trend? Who's going to own the levels in the Russell? When I say own the levels, do the bulls ultimately own the 200 exponential, this 200 propulsion, and that's support, and therefore could be a foundation for moving higher? Do the bears ultimately end up owning that level where it's a ceiling and maybe a catalyst for more traders to look at this as a market that's moving lower? For now, I'd say the bulls own it. For now, I'd have to be bullish. The only thing I could say I'm disappointed about, because we got long Russell, is that I was looking for this market to just get to in front of 2300 on the RTY, which would translate into a target on the IWM. I'm still bullish I still believe that there's probably mildly a little bit more path of least resistance to the upside than the down. But I'll tell you what, this isn't a trend. And the further away we get from a trend, the closer we get to chop, it's far harder to have clear directional bias. It's far harder to have that, what I think is much better pinpoint accuracy on what a dip is, what a rip is. Is this a buyable correction? Is this a buyable retracement? And so chop is always very tricky until you get to the edge of chop, meaning the floor, the ceiling that actually embodies the range that the market is in. So in the middle of chop or away from that floor or ceiling, our probability of finding a really good trigger starts to go down. All right. So I hope that makes sense. All right. Let me pick it up here on some of these questions and let's get to it. Oracle is hitting the fib. I see it going higher. So here's the thing with Fibonacci work, Tim. It is subjective. It is a higher skill level tool because the points from which we all choose to pull a fib retracement can differ. So I'm not going to necessarily go there. But as far as your question goes, do I see us moving higher? Let's get past earnings. Let's see how we react after earnings. But as long as we're above the 200 propulsion, and as long as we segue into chop, because this market is chop, let's keep that in mind. As long as we are segueing out or into chop, but the preceding trend was bullish, that's fine with me. So notice how we were green over green and that went yellow. That transition still carries with it, not a trend any longer, but definitely bullish bias. So generally speaking, yes. Generally speaking, yes. Can we take a look at Costco? Earnings were yesterday. Of course. So, Costco was tricky because we had a nice pullback inside that 2-week window. But Costco is an uptrend. So what I would, if I'm playing the aftermath of earnings, I rarely am in the market through earnings. I like to be in there 4 to 6 weeks before playing the trend. I'll get out during that melee. And then after, I'll look to see as the dust settles, is there another opportunity presenting itself? For us, that opportunity is probably going to be 524.35. Let's see this market come back down to the wave or even lower. And let's buy it because at the end of the day, it's a buy the dip. And maybe earnings volatility is the catalyst for that opportunity. So thank you for the question. All right, let me grab a few more symbols here. ASO, sure. Chop, but it has bullish bias. Please, when you're prioritizing your watch list, humor me maybe for a week or a month. When you're prioritizing the names on your watch list, try to find names that are bullish, clearly still in uptrends. And when you do that, you're going to find your probability across, a group of trades, not individually, there's no guarantee in trading. But when you look at the probability across a group of markets that are in uptrends, your probability of seeing continuation and being able to buy the dip or even buy the bounce, whatever your preference is, exhaustion versus momentum, you're going to find it works better. It just works better. The more we segue into chop, the levels become softer. They're not as solid. The price action can be, it feels like you're flipping a coin every day. Is today the up day or is today the down day? Because the clarity psychologically reflected by the technicals and the price just isn't there. And that's going to be my issue with any choppy market. So ASO, if it gets down to support, perhaps, but I don't have anything I can do with it, right? There's not a lot that I can work with. Carla asks, I'm new to trading. Which one of my master classes? Oh, gosh, Carla, what I would say is I have two styles that I embrace. I'm a day trader in the morning, and I like to look at daily time frames in the afternoon. So I guess the first question is, are you looking to be a day trader? In which case, my most recent day trading playbook was super well received, very highly rated. Surveys, I was just sitting down with the office. The surveys were very, very positive on those. So people liked it. I still get feedback from it. If you want to day trade, that's it. That's the one to do. And if you want to do the longer term stuff, what I would tell you is, sure, you could take my recent ETF masterclass, but I would say come join us in the mastery. Come join us in the mastery. Get an immersion with myself and the other members who are using this style. Get an immersion for 3 months, and you're gonna find after 3 months your trading knowledge is going to be significantly different. Dare I say better than it was when you got in, and it's really it's an immersion of 3 months with a live trading environment. So I think those two would be my recommendation. All right. As far as day trading, Michael, always follow the volume, and I still believe the volume is in December. It won't be for long, but just follow the volume. I haven't looked this morning, but last I checked, the volume was still in December. So for open interest, that's going to be my longer term plays. Volume is going to be where I'll focus on shorter term. Okay. All the questions on CPI, I love them. Tells me you all are looking at the calendar, which is great. However, what I would also say is don't draw a direct line from CPI to stonks. Make a pit stop now to the countdown to FOMC. If you've been in any of the rooms, I've been talking about it. I'll be doing a Q&A, our typical weekly Q&A session. So if you're in the futures room, if you're in the mastery, come join me at 3 o'clock. We'll definitely be diving into this. No doubt. No doubt. And I'm trying to recall if I did a free video on this for non-members. I might have. So keep an eye on those free videos that I do and post at the Simpler Trading YouTube channel. A lot of the ongoing narrative about what I'm doing and why is explained in those videos. So I love all those CPI questions, because look, I don't want to trade the CPI. I'm not interested in telling you, hey, let's trade the volatility. We don't want to go into the mosh pit. But it's a cue and a clue. It's a cue to volatility. And it's a clue as to whether we can continue to expect the Federal Reserve is simply going to stay on that June trajectory, which, quite frankly, if that's the case, sort of clears the path for a potential Santa rally. Please remember, gang, the Santa rally, Trish and I were talking about this yesterday. And if you're confused about what the year-end rally is, tax loss harvesting, Santa rally, window dressing, all of that, if all that jargon and the timing is throwing you off, we're working on the next couple of issues of the Countdown Trader newsletter over at countdowntrader.com. I guess it's a blog, countdowntrader.com. We're working on that because the crux of that Santa rally really is the last 5 days of this, the last 5 trading days of this year. CVX is gorgeous. Deborah, buy the pullbacks. Yeah, absolutely. Buy those pullbacks. And sorry, I know I've run over a little bit, but as always, thank you so much for joining us for Charts and Coffee. Love our caffeinate and dominate crew. I'll see you all on Monday. Some of you all I'll see in the Mastery and Futures end of week Ask Me Anything session from 3 to 4 p.m. today. If you're not a part of the Futures room, check out a trial. If you're not part of the Mastery, come join us. These 3 months are going to be an immersion, probably unlike anything you've ever had before. I'm looking forward to seeing you in either place or right here at Charts and Coffee, which is great too. Be good to each other. I'll see you next week.